Hello everyone, you're very welcome back to the channel. Today, I want to talk about the recent collapse of Silicon Valley Bank in the US. Specifically, I want to talk about what the bank's failure means for European bank depositors. There's been lots of fear and misinformation circulating online about the nature of these failures and what they could mean for the global banking system. I've seen comparisons being made between Silicon Valley Bank and Lehman Brothers, the insinuation being a repeat of the global financial crisis. Let me make one thing abundantly clear. This is not a repeat of 07-08, not even close. The banking system in 2023 is in a completely different league safety-wise as compared to the banking system pre-global financial crisis, and that's especially true in Europe. The executive summary here is that European bank deposits are safe. The failure of Silicon Valley Bank and other banks like Signature Bank and Silvergate have little to no bearing on European banks and European bank deposits. The goal of this video is to help you understand why. First, I'll explain the situation with Silicon Valley Bank and what happened. I'll then take a holistic view of U.S. banking regulations to explain how this was allowed to happen. Next, I'll talk about how the collapse of SVB affects Europe. We'll then take a look at the recent panic surrounding Credit Suisse, followed by a discussion on deposit insurance and a brief conclusion. When looking at the collapse of Silicon Valley Bank, the obvious question to ask is what happened? So let's start there. The first piece of the puzzle is SVB's customer deposits. SVB saw customer deposits jump from $49 billion in 2018 to a peak of $189 billion in 2021 and $173 billion by year-end 2022. It wasn't just SVB who experienced huge growth in deposits. In fact, there were large spikes in U.S. bank deposits across the board in 2020 and 2021. In the case of SVB, their depositors were primarily startup companies, ranging from pre-seed and seed all the way to Series A, B, C, and beyond. This is why SVB shouldn't be compared like for like with average high street banks. SVB's deposits were exposed to concentration risk, a high concentration of depositors from one segment of the market, startups. That'll become relevant later on. The second piece of the puzzle is SVB's assets. What do banks do when they receive deposits from customers? They lend them out. This is the basic function of a bank. Borrow short, lend long. In other words, borrow short-term money from depositors and lend that money out on a long-term basis. Many people forget that customer deposits are liabilities for banks. Banks are obligated to return deposits to their customers as needed. Deposits also cost the bank money, seeing as customers receive deposit interest from the bank on their deposits. Therefore, the bank's goal is to receive customer deposits, lend those deposits out, and earn a higher rate of interest on the loans than the rate of interest paid on the deposits. When SVB started to receive large influxes of customer deposits, the priority would have been to find prospective borrowers to make loans to. However, SVB wasn't making enough loans to generate an adequate return on the deposits it was receiving. So what did they do? They invested. This is a breakdown of SVB's assets at the end of 2022. Of the $212 billion worth of assets held by SVB, 55% or $117 billion was invested in fixed income securities. 35% or $74 billion was tied up in loans, and 7% or $15 billion was held in cash. By tracing SVB's fixed income investments back to their financial statements, we can identify some problems. In 2021, SVB invested over $80 billion in fixed income securities, a year-over-year increase of 491%. The vast majority of SVB's fixed income portfolio was composed of long-term debt, fixed income products that had maturity dates in excess of 10 years. SVB's intention was to hold these investments until maturity, at which point their invested capital would be repaid. The key thing to note here is the weighted average yield of SVB's long-term fixed income portfolio, 1.61% as at December 2021. This is the rate of interest that SVB's long-term investments were generating. That brings us on to the third piece of the puzzle, interest rates. Here's the problem. When SVB invested $80 billion in 2021, US interest rates were at rock bottom. What happened next is the exact reason why you shouldn't invest in long-dated fixed income products when interest rates are at rock bottom. The US Federal Reserve began to increase interest interest rates dramatically between 2022 and 2023 in order to combat inflation. As a result, 30-year fixed mortgage rates rose from 3.11% at the end of 2021 to 6.42% by the end of 2022. The reason why we're referring to mortgage rates here is because SVB invested $56.5 billion in long-dated mortgage-backed securities in 2021. As mortgage rates rise, mortgage-backed securities decline in value in a similar but not identical fashion to regular bonds. Look into negative convexity if you want to learn more about that. The effect of rising interest rates left SVB with a large unrealized loss on their hold-to-maturity fixed income portfolio equal to just under $16 billion as at September 2022. The existence of this loss alone was not the downfall of SVB. Unrealized losses on fixed income securities don't operate in the same manner as unrealized losses on equities. With equities, you can only recoup your loss if the security subsequently increases in value. With fixed income, you can simply hold the investment until maturity and you'll recoup the full value of your invested capital. This is especially true for fixed income products that are backed by the US government, like the ones that SVB were invested in. All SVB had to do was hold these investments until their maturity and those unrealized losses would cease to exist. That would have worked had it not been for the fourth and final piece of the puzzle: panic. On March 8th, SVB announced that they had sold substantially all of their available for sale fixed income portfolio for $21 billion, which is much smaller than their hold to maturity portfolio. This sale resulted in a realized loss of $1.8 billion. In addition, SVB announced that they were raising $2.25 billion through the issuance of common shares and preferred shares. SVB's efforts to raise money spooked investors, and the stock fell by 60% in response. At this point, venture capitalist firms, who are the financial backers of startups, were advising startup founders to withdraw their money from SVB. From their perspective, only the first $250,000 in SVB deposits were insured by the FDIC for each startup, and many of these startups had huge deposits with SVB, so it wasn't worth the risk. This is where SVB's highly concentrated depositor base would come back to haunt them. A significant portion of their depositors tried to withdraw their money at the same time. $42 billion worth of attempted withdrawals in one day. This is what's known as a bank run. Bank runs are self-fulfilling prophecies. Depositors withdraw their money in fear of a collapse, which ultimately causes a collapse. Remember, at the end of Q4 2022, SVB only had $15 billion in cash, and they had another $21 billion from the sale of their investments. That still left a massive shortfall, meaning if SVB was to service these deposit requests, it would need to start selling investments from its hold to maturity portfolio, the portfolio that was trading at a $16 billion loss in September. With enough withdrawals, SVB would eventually become insolvent. In the space of 24 hours, SVB had a negative cash balance of nearly $1 billion, and the FDIC pulled the plug. Let's be very clear on a couple of points. Number one, SVB's depositor base was highly concentrated in one segment of the market, much more concentrated than your average high street bank. Number two, SVB's management made some really bad investment decisions at the worst possible time. And number three, the actions of venture capitalists spread fear among the startup community, which ultimately led to a run on the bank. These perfect storm conditions limit the comparability of SVB to other banks, and those limitations have to be considered. However, while it's good to know what happened, the more important question to ask is, how was this allowed to happen? Because answering that question requires a holistic assessment of U.S. banking regulations. The best place to start is the Basel Accords. The Basel Accords, specifically Basel III, refers to the minimum requirements and safeguards that were imposed on banks internationally in the wake of the Lehman Brothers collapse in 2008. Under Basel III, two key ratios were introduced: the liquidity coverage ratio, or LCR, and the net stable funding ratio, or NSFR. These ratios are imposed on both US and European banks and are designed to protect depositors, banks, and the stability of the financial system as a whole. The LCR measures a bank's stock of high-quality liquid assets relative to the net cash outflows, i.e. deposit withdrawals, withdrawals that the bank might experience over a 30-day stress period. In other words, does the bank have enough cash and liquid assets to meet a high level of withdrawals? Liquid assets refers to investments that can easily be converted back into cash without having to sacrifice on price, i.e. short-term government bonds. A healthy bank will have an LCR well above 100%. The higher the LCR, the more likely it is that a bank will be able to deal with a reasonably sized bank run. The NSFR, on the other hand, is designed to limit mismatches between a bank's long-dated, illiquid assets and their readily available funding from deposits and other sources. Banks with NSFRs in excess of 100% are considered to be in good standing. The NSFR is more complicated, but it's similar to the LCR in the sense that it seeks to ensure the strength of a bank's liquidity. That begs the question, why didn't SVB's LCR and NSFR sound alarm bells to regulators about the bank? Well, firstly, SVB wasn't subject to the requirements of Basel III. As per their financial statements, we currently are not subject to the Federal Reserve's LCR or NSFR requirements either on a full or reduced basis. That's because the U.S. Federal Reserve decided that instead of applying Basel III to all banks, they would only impose the full LCR and NSFR requirements on the biggest of banks. But make no mistake about it, SVB was a big bank, the 16th largest bank in the US. But because of the high thresholds set by the Fed, it wasn't subject to the liquidity requirements of Basel III. Secondly, there's no guarantee that even if SVB was subject to Basel III, that the LCR and NSFR metrics would have sounded alarm bells about the situation. In fact, recent analysis suggests that SVB would have been compliant with the LCR requirements of Basel III. That's not to say that the Federal Reserve is correct to exclude banks from Basel III. By comparison, the European Central Bank applies Basel III and its requirements to all banks in the European Union. The fact that SVB could have been compliant and yet still failed highlights the importance of managing not only liquidity risk but also interest rate risk. SVB's problem wasn't liquidity. It was the fact that the value of their assets had been decimated by rising rates. Data from the FDIC shows that SVB isn't the only bank with large losses from rising rates. At the end of Q4 2022, unrealized losses on the balance sheets of US banks amounted to $620 billion. Notice the foreshadowing here from the FDIC chairman. The combination of a high level of longer-term asset maturities and a moderate decline in total deposits underscores the risk that these unrealized losses could become actual losses should banks need to sell securities to meet liquidity needs. That's exactly what happened to SVB 1 week after this speech was given. Unrealized losses in their hold-to-maturity portfolio became a problem when they were forced to sell assets and realize losses in order to meet withdrawals. This exact scenario, large unrealized losses caused by rising rates, was discussed in a 2014 commentary piece written by former employees of the Federal Reserve Bank of Cleveland. Going forward, just like how Basel III introduced liquidity requirements, standardized requirements should be introduced for the effective management of interest rate risk, namely hedging. Consideration also needs to be given to the fact that just because a bank's intention is to hold an asset until maturity, a situation such as a bank run could derail that intention entirely. Banks should be required to forecast how the realization of losses in such a scenario would impact its solvency. Granted, the US Federal Reserve, in response to the SVB collapse, launched the Bank Term Funding Program. This allows banks to secure 12-month loans from the Fed while pledging any government-backed securities that they may own as collateral, such as US Treasuries and agency mortgage-backed securities. US banks can therefore extract cash from their long-term fixed income portfolio without having to sell the assets, thereby avoiding realized losses. Crucially, the assets will be valued at par, meaning the bank will be securing loans against the maturity value of their assets, not the market value. The FDIC report also shows large deposit withdrawals throughout 2022, further highlighting the need for sufficient liquidity to meet those withdrawals. That begs the question, how does all of this affect Europe? Well, the first thing to note is that Europe's direct exposure to the collapse of Silicon Valley Bank is zero. This was confirmed by Eurogroup President Pascal Donoghue. European banks are in good standing, and there is no direct threat posed by SVB's collapse to the stability of the European banking system. However, that's not to say that there's zero risk of contagion in the form of bank runs. European banks could find themselves under pressure if panic sets in and depositors start withdrawing large amounts of cash. The banks themselves aren't in a bad financial situation right now, but the actions of depositors, namely a bank run, could put the banks in a bad financial situation. That's why banks and governments need to ensure that depositors trust the banking system. Otherwise, everything falls apart. There are plenty of reasons to have faith in the European banking system. We already mentioned that the requirements of Basel III are imposed on all European banks. Digging into the data, the weighted average LCR for European banks in June 2022 stood at 166%, well above the minimum requirement of 100%. However, we can't rely on the LCR alone, because as was proven by SVB, you can have liquid assets that are trading at large losses. So what about the bond investments owned by European banks? Are they too sitting on large unrealized losses? There's no denying that the value of these investments have declined as a result of the ECB's rate hikes. However, as was noted by Moody's, 1/3 of European banks' government bond holdings mature within the next 2 years, ensuring a continuous inflow of cash and reducing the need to sell assets. As these bonds approach maturity, their market values will start to converge on their par values, which is known as pull to par. Hence why unrealized losses on government-backed fixed income securities are only a problem if you have to sell. Moody's also noted that based on their sound liquidity and funding profiles, i.e. LCR and NSFR, their cash holdings and their stable deposit bases, i.e. low concentration risk, we consider large European banks are generally well placed to avoid the need to sell their bonds at a loss, an entirely different situation to SVB. Further insights from Morningstar suggest that while bonds held in the available for sale and held to maturity buckets made up 55% of SVB's assets, the equivalent for the average European bank is only 8%. Drastically different asset profiles. At a macro level, European banks are subject to macroprudential regulations, the extent of which can vary from country to country. Certain minimum capital requirements are imposed on all European banks uniformly. Member states can then tack on additional requirements for banks to adhere to. The use of risk-weighted assets, or RWAs, is used to determine the minimum capital requirements for banks under Basel III. Interestingly, banks aren't required to hold capital against sovereign bonds, i.e. government bonds that they own, because sovereign bonds aren't considered to be risky assets. In light of the SVB collapse and the accumulation of large unrealized losses due to rising rates, it'll be interesting to see going forward if banks will be required to hold capital against any sovereign bonds that they own. Bottom line, the European banking system is safe. Inevitably, some of you are probably asking, what about Credit Suisse? To which I'll respond, what about Credit Suisse? The market's reaction to the Credit Suisse situation was a total overreaction. Credit Suisse's auditors, PwC, noted weaknesses in the bank's risk assessment procedures and weaknesses in the bank's internal controls over certain aspects of the cash flow statement. While it's definitely not a good thing that internal control deficiencies were found, this was in no way suggesting that Credit Suisse was about to become SVB Part 2. In fact, everyone conveniently ignored that PwC concluded that Credit Suisse financial statements fairly reflected the financial position of the bank as at the 31st of December 2022. When we look at those financial statements, we can see that Credit Suisse had an LCR of 144% at the end of 2022, which stood at 150% on March 14th, well above the minimum of 100%. Granted, Credit Suisse's LCR is down from 203% at the end of 2021. Credit Suisse also had an NSFR of 117%, down from 127% in 2021, again above the minimum requirement of 100%. Furthermore, you can also see that 87% of Credit Suisse's asset base is made up of assets that vary in maturity from on-demand to less than 5 years. Compare that to SVB, where the majority of their assets were invested in fixed income products that weren't set to mature for over 10 years. It's just not comparable. But yet, because of the market's overreaction, the Swiss Central Bank were forced to issue a statement that read as follows. The Swiss National Bank, SNB, and the Swiss Financial Market Supervisory Authority, FINMA, assert that the problems of certain banks in the USA do not pose a direct risk of contagion for the Swiss financial markets. The strict capital and liquidity requirements applicable to Swiss financial institutions ensure their stability. Credit Suisse meets the capital and liquidity requirements imposed on systemically important banks. If necessary, the SNB will provide Credit Suisse with liquidity. So make no mistake about it, the regulatory authorities are comfortable with Credit Suisse's financial situation, but as a precautionary measure, Credit Suisse is going to borrow up to 54 billion from the Swiss Central Bank. This, in my opinion, is being done to shift the narrative and to reduce the likelihood of a potential bank run. That brings me on to the topic of deposit guarantees. The FDIC's response to the collapse of SVB has shown depositors that the US government is willing to step in when things go south. In the US, bank deposits are insured by the FDIC up to the value of $250,000 per depositor per insured bank. So if you held less than $250,000 with SVB or any insured bank, it doesn't matter if that bank goes under. Your deposits are 100% protected. The problem arises when depositors have more than $250,000 in deposits with one bank, like the majority of startups had with SVB. Technically, these deposits are uninsured. So if the bank goes under, the maximum you can claim back is $250,000. Hence why venture capitalists instigated a bank run. But the FDIC made the decision to protect all deposits held with SVB, both insured and uninsured. This was made possible through the use of what the FDIC is calling a systemic risk exception, aka a bailout. Funny how SVB wasn't considered large enough for Basel III to apply, but when it fails, all of a sudden it poses a systemic risk. The FDIC also made it clear that no losses associated with the resolution of Silicon Valley Bank will be borne by taxpayers. While that might be true in this one isolated incident, where does it end? What's the point in having deposit insurance if bank failures are just going to be bailed out? What kind of message does this send to the banks with respect to accountability? Does that mean that a failure of any bank larger than SVB would automatically qualify for this systemic risk exception? And if so, is it really realistic to expect no cost to accrue to the taxpayer? Even emergency measures like the Bank Term Funding Program have proven that the government is ready and willing to step in to save the banks. We have to ask ourselves, is that sustainable? In Europe, deposits are protected under the Deposit Guarantee Scheme. This protects deposits up to the value of €100,000 per depositor per institution. The question is whether or not member state authorities would step in to protect non-guaranteed deposits if a situation similar to SVB was to occur. Let's hope we never have to find out. In conclusion, European bank deposits are safe. The collapse of SVB has no bearing over the stability of the European banking system. As we've shown, SVB's failure was a byproduct of perfect storm conditions that lack any meaningful comparability to major European banks. In addition, European banking regulations are more prudent than the US. There is no data to suggest that the European banking sector is at risk of collapse. In the case of Credit Suisse, the Swiss Central Bank has reassured stakeholders that Credit Suisse is in compliance with Basel III, thereby proving the market's reaction to be excessive and a byproduct of poor timing. That's not to say that there's zero chance of a European bank failure in the future. Facts and circumstances change. The uncertainties of the future could very well have negative effects on the banking sector. In the words of the FDIC, the banking industry continues to face downside risks from the effects of inflation, rising market interest rates, and continued geopolitical uncertainty. These factors could hurt bank profitability, weaken credit quality and capital, and limit loan and deposit growth. We can't predict the future. Ultimately, it's your responsibility to ensure that you're comfortable with your bank's financial position, because at the end of the day, you're making a conscious choice to leave your cash on deposit with one bank over another. Let me know what your thoughts are on the current state of the banking sector in the comments section. If you enjoyed this video, you can show your support by leaving a like, subscribing to the channel, and sharing the video with family and friends. Before you go, you might be interested in this next video, which explains the Irish debt situation and how the country came to have one of the highest per capita debt burdens in the world. Thanks very much for watching, and I'll see you soon.